Hi everyone, thanks so much for watching. Today's video is really all about layered insurance and how we can layer like a pro. Quite oftentimes we'll find our clients, they need a lot of insurance up front, but as sort of their liabilities change, the need for insurance may drop away or may change over time. Now there's a couple different ways we can do this. I'm illustrating this in life design analysis. Again, a visual always helps clients really understand those changes and really, you know, when we say insurance drops off or is a term rider, sometimes that kind of jargon can really confuse our clients. Now, what I'm going to do is I'm going to create a new case here, and I've created a client called Mr. Layer, and you can see I've created him here. Now, Mr. Layer here happens to be a 40-year-old male. So I'm actually going to set his age here and say he is age 40 because I haven't set a birth date in the system for Mr. Layer. Now there's a couple of different ways to do this. You know, if you are doing a whole life permanent base with term riders and the illustration software and you're using the spreadsheet already, you know, sometimes that's the easiest way to do it. So again, I could say I'm looking to add a whole life and, you know, for the sake of it, I'll pick Equitable Life Whole Life here. Now, one of my favorite ways of layering is for insurance companies that actually allow you to do a T10 layer, a T20 layer, and a permanent base. And again, really easy in our software, again, especially the fact that we can use the whole spreadsheet file. One of the reasons we do that is because in the illustration software, again, we can design a specific quote to include these layers. So you can see what I've done here is I've actually done a 20 pay where 1/3 of it, or 1/3 of the million total coverage that I'm going to go for here is this permanent base, and it's the estate plan. But I've also included, again, and we can customize these riders and things like that, I've also included a third rider of T10 and a third rider of T20. So each one of these components, the T10, 20, and whole life, each make up 1/3 of the insurance. But you can see I've also designed them to fall off at critical ages. So again, my client's 40. I'm going to say I want the T10 to fall off at 50 and the T20 to fall off at 60. And again, I just don't want them to see those guaranteed renewals. We're going to assume that our client's needs changes. Now, as always, you know, again, we can say we want to view the spreadsheet data. Again, we've got a great premium here for that insurance benefit. And again, we can see how it staggers over time. We want to show that to our clients though. So what we're going to do is we're going to export all this information to Excel. I'm going to select the whole thing. And what we're just going to do is just copy and paste the spreadsheet in there. So again, really simple way to layer insurance in there. Now, sometimes we want to layer products that don't offer riders, especially multiple riders, and I want to show you a way to do that as well. So let's take a look at the second way that we can layer. What I'm going to do is I'm going to start with the same sort of case, and I'm going to say we want 333,333, so 1/3, but this time we're going to say universal life, and I'm just going to search the rates in LDA. And again, we'll search all companies here. And we can add any different company to the list from the survey here. So I'm going to go with BMO. It's right at the very top. And I'll add that 1/3 of that product there. Now, the second one that we want to add to that BMO is going to be some term 10, just like in the other scenario. But again, instead of designing it as a rider, what we're going to do is we're actually going to manually search. Because you may make your own layers from different companies as you see fit. You know, I'll leave that up to you guys when you actually facilitate these. But again, you can add, you know, different layers like CI layers or anything else. Now, I'm going to add this Empire Life Solution T10 as my layer. And I'll show you when I do actually add it to the case here, I have the option to stop it before the next renewal as well. You know, typically when we add to case, we get the guaranteed renewal, but we can always go in here and actually say edit plan. And we're just going to say this is renewable to 50. So we're going to say we want to drop it at 10 years. So we'll actually override that renewable age. Of course, because our client is 40 here. Now the next layer I want to add in here is I want to do a search for term 20. So I'm going to repeat the search, and again, you can mix these layers as you see fit as well and design them for your client's changing needs in the appropriate amounts. But I'm just doing thirds. Again, feel free to mix up those fractions as well, and I'll do a term 20 here. Again, I can go down the list and look for any different company. You know, maybe to make it simple here, I'm just going to say let's add this BMO term 20, add it to the case. And again, what we want to do is when it has added, again, I'm just going to again change it so that we don't see anything past that renewal. So I'm just going to say renewable to age 60, just so it caps it before we hit that guaranteed renewal. Now what we can do here, once we have all of our products or all of our different layers, we're going to combine these. So all I'm going to do is I'm going to hit combine plans. And again, we may have a multi-policy discount with with some of these products if we were to actually all use BMO. But I'm just going to leave that out for now. I'm just going to say combine the three of these. This is our universal life layer, our T10 layer, and our T20 layer. And again, you can always customize and change the names of these as well. But you can see now we've got one kind of addition of all those three layers. And so, two different ways to stagger insurance plans, but that should help you when you're actually designing these layers. One way is through the illustration software. One is by selecting individual products and comparing them. Now let's take a look at the report and see how it looks. Perfect. So we have our report for Mr. Layer, and again, we've designed two different ways really quickly to show or accomplish this layering of insurance plans. Now let's compare them to see which option is actually better for our clients. So again, you can see one, we've got a little bit of universal life that will have actually a component that actually goes on for life. But you can see initially here's our total premium of all three of those layers. Again, after 10 years, we actually have one of those layers dropping off, that term 10, we've lapsed it. So it's actually going to expire, and we'll show that as well when we illustrate. And then again, we have the premium actually reducing again further at the 20-year mark because we've dropped off that term 20. Now, when we look at the whole life example, we designed it as a 20 pay. So for the first 10 years, we've got a term 10 rider on there that's actually going to drop and reduce the premium. But at the 20-year mark, not only does the term 20 policy drop off there, we also have a guaranteed 20 pay. So we stop paying premiums there. Now, when we take a look at these premiums, again, we do see some staggering here. So we can see a couple slight reductions of those term premiums. Really puts into perspective how nice and affordable term is. And we've also got a nice sum of premiums. And you can see here, one is the 20 pay is paid really up front, but then we do actually, we don't have to deposit anything else. With that UL option, again, we're steadily seeing an increase because we still have that permanent base. And by age 99, we end up roughly in the same place. So I might look out here around year 86 or 85 and say, around life expectancy. Similar premium levels. It looks like just off the top of my head about a $60,000 difference here. But we'll analyze and see, if there's more value in one plan to offset that $60,000 difference. Now again, we're also going to look at certainly cash values. When you mix plans, it is going to look at cash values. And this one plan with the Universal Life has no cash value. So all we're seeing here in red is this premium deposit. Whereas the other plan, that Equitable Life, it still had, because it was a permanent plan and 1/3 of it was that permanent base, it still had a nice cash value. And what I think clients really like to see in this sort of strategy is that, no matter what, they want more cash in the policy than they've paid. So it really, even with those term riders and the costs incurred for that, it's nice to see that because of that third base that of permanent, that there's more cash. And of course, always look at the guaranteed examples, always look at the reduced examples and show your clients these. It's that kind of transparency that gives them confidence and an understanding in the product. Again, the same sort of thing when we look at the insurance benefits for each of these. This one being with that Universal Life. Again, we start at $1 million. We can see as we age here at year 50, we have that term 10 drop off. Again, at 20 years, we have the term 20 drop off, and we're left with that $333,000 of permanent insurance over time. And again, this is a great strategy to say, life changes, but we do need, while you're young, we need lots of coverage up front. And as we pay down the mortgage and as the kids get through school and things like that, our need for insurance may reduce, and we've actually planned for that. So that's that layering of insurance. Now, when we look at the other chart for the whole life, we're going to see a very different chart here because of those paid up additions. So same sort of staggering or staging effect where at the end of 10 years, we drop off with that term 10, but you'll see the drop is not as drastic or it's not as clean because we have those paid up additions constantly working their way back up to the original insurance amount. And these kind of little, I'll try and point it out here a little bit without covering it up. These little triangles are basically the gaps in the coverage if that level is $1 million. But it's nice to see if we go out here age 85, that we have more than that insurance, that $1 million of insurance mark. Again, we can overlay the two and see that, at the end of the day, really the superior solution here is going to be the whole life as far as insurance coverage, but it did cost more. So we might also want to look at things like an internal rate of return comparison on the two of them. So I'm just going to kind of go through here. And of course, one is going to be superior in the cash value because the other one does not have any. And when we look at it from an insurance standpoint as well, again, much stronger IRR with the use of the permanent product there. But, either way you decide to layer, I mean, these are great insurance strategies to really just help show clients the changing needs over time and really suit the product that we're selling to their needs the best possible way we can. Again, no one wants to carry too much insurance, but on the other hand, of course, no one wants to be underinsured. So hopefully this lets you satisfy a nice balance for your clients and, again, find the right mix of, what products you're going to layer. So thanks so much for watching, and any feedback, send it my way.